Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
When it comes to equity markets, this was taken before we had the shutdown news, but we know that there was a bit of a sense check running through equity markets. So this has been kind of bubbling up for some time. We've had the records hit. We've had the equity markets steaming ahead. We've had very strong earnings. I know you mentioned that. And there has been best earnings in years, the strongest earnings growth since 2021. But just getting back to what that's looked like in terms of markets. So clearly, there has been a sense that perhaps there was this interconnectedness of AI was of concern. There was a look at Michael Burry with his high-profile shorting of Palantir as one, and some very defensive reactions among those companies to this. And just a sense that maybe some of this had got ahead of itself. And we can see that in the past week, tech stocks, Microsoft, Meta, Nvidia, Palantir, all had fallen, in some cases quite down near double digits. However, that we can see that the quantum stocks too have been trading in a league of their own. So definitely this kind of bifurcation in the market. I always like to ask this question among allocators, CIOs. How do you think about this new behavior of a segment of the equity market, this concentration, this quite reasonable volatility if we're seeing stocks falling by 10, 12% in a week, and just that breakaway of certain sectors like quantum, like AI? How do you think about that in a portfolio construction context?
Well, it produces real challenges to portfolio construction and makes risk management and ideally proactive risk management, so risk management before you trade, not after, much more important. And it's not going away. So I think trying to put this in lay people perspective, the concentration is driven by winner takes most business models. You know, if two companies are going to the same space, the one that gets slightly ahead ends up with 80% plus market share. The other one maybe isn't around anymore. So the winners win big and the losers go out. And as opposed to kind of more evenly distributed market dynamics we may have had with other business models historically, but also that concentration and that winner takes most dynamic as digitalization and AI come to other sectors that we don't think of as tech. Think restaurants, think garbage trucks, think anything in your life is getting increasingly digitalized. How I buy my subway tickets and my metro tickets to commute into work, it's completely digital now. I haven't touched the physical ticket machine in years. You know, it's coming everywhere. And so you now have winner take most in business models and increased market concentration in business models where we didn't see that historically. As an OCO, we favor a direct implementation approach where we get the model portfolios from our different sub-advisors. We know what risk exposures we're going to have before we implement their desired trades, and we can aggregate those up to try to stay within the risk bounds of our clients and avoid undue concentration. I think that's an improvement on historical OCO models where the capital is allocated out, the sub-advisor traded independently, and then you found out the next day, oh, we're 3x the market weighting in the stock, which already had a high weight. And now we've got too much risk there. What do we do about that after the fact? So I think I give that example to illustrate that capital market participants are adjusting to this increased market concentration and volatility in real time. You mentioned shorting. I think it's a huge benefit for U.S. capital markets that we allow shorting. We have a healthy hedge fund sector. It keeps market efficient. It maintains. It gets capital to the highest and best use quickly, which then drives labor to the highest and best use quickly. You know, that produces creative destruction along the way. But there's a reason why the U.S. economy has massively outperformed, for example, the Japanese economy or even the Chinese economy in recent years. And that creative destruction, that quick funding of the winners in this winners takes most dynamic matters a lot. The collective bet on AI and digitalization. So I'm going to say something that's kind of contradicting itself on the surface. I believe that we are still underestimating as a society and underfunding the AI and digitalization boom because it's so transformative in the industry sectors where it's happened. At the same time, there will be individual companies that have a big market cap today, both publicly traded and private, that go to zero not because AI and digital is wrong overall, but because some other company that's currently smaller and has less of a brand, less well known, disrupts them from below. And so you better be diversified. I mean, the short answer is in this increased concentration and with this volatility, the best answer is diversification. If you want to gamble, I think the stock market's better than a casino for that. But if you want to invest, diversification is key.